Well, everybody, thank you for coming to Financial Language, where money does have a sound. Appreciate you all being here this morning. I got my clubhouse with me. I got my live stream going on. I'm just really, really blessed today. I got some good news. We're going to talk about some mortgage rates today. Financial Language, money really does have a sound. Appreciate you all coming in. Let's get down to business. All right. Well, welcome, everybody. I appreciate everybody being here today. I want to share something with you on YouTube concerning what Dave Ramsey said about the mortgage. I want to know if you kind of agree with this or not. Can everybody hear me? Can everybody hear me? Can you hear me? All right. There we go. So we're going to talk about some of these mortgage rates right quick, because I want you to hear what Dave Ramsey had to say about the mortgage rates, because I think it's important that, hey, you understand exactly what is going on in the mortgage world. Is it changing? Yeah, it is. Now, I can't tell you what it's changing to be, but, well, I can tell you some of it, but I can't tell you everything, but I can tell you some of it. I truly believe we're about to take a plunge. I do. But we've been through this. I think it was 2009, 2008. We went through this same situation. Had a whole little pandemic went on back then. I wouldn't call that a pandemic, but state of emergency. So let's hear what he has to say right quick. Here's Dave Ramsey talking about mortgage interest rates are high.
The thing that's happening with real estate is interest rates have gone way up. They're bumping up close to 7% now on a 30-year fixed, up from the threes. And, 7% in the scope of a life as long as mine is very low. I remember lots of years selling real estate, 11, 12%, 10%, 9%. Lots of years I was on the radio, it was 10%. When I started the show, it was 10%. And so then it came down to 6, and we thought we were in nirvana. But then when it goes to 3 and it goes up to 7, see, 7's not good as compared to 3, but it's really good compared to 12. So it's an emotional thing. So here's what I'm telling you. The other article we got was from Bloomberg, talks about the people that have bought homes, their values are continuing to go up, especially if you bought like in Austin, Texas, Nashville, Tennessee. You bought in these areas, Dallas, Texas, you're buying in Phoenix, Arizona. Have they gone down a little bit in some of those areas in the last 4 or 5 months? Yeah, a little bit.
Well, asking prices too.
And this price asking, because some of it really gone crazy up. And so it's settling, but it's not diving, it's not crashing. And what's happening is these people that bought are going to become inordinately more wealthy over the next 3 years than people who rented, because rents are also going through the roof. And so rents are sucking the disposable income out of the renter's budget, where when you buy, because guess what happens to rents? Every year they go up, just about. Almost every single year rents go up. When you buy a house at 6% or 7%, it doesn't go up. You're locking in one of your largest expenses, and the value of the property is going up because it's not crashing. Unless you're in one of those areas we mentioned, right? It's not crashing. Overall, we don't have a 2008 situation, and you're going to become wealth inequality based on home ownership is going to be more and more of a thing. And so what all that is to say is, if you haven't bought a house and you're thinking about buying a house and you're sitting on the sidelines waiting on interest rates to come down, they're not going to come down in any minute. And waiting on house prices to come down, they're not going to come down. They're going to go up. You need to go buy a freaking house right now. It's a great time to buy a house because there's not a line of people around the block trying to buy that house right this second. You're not going to steal it. And if you're getting ready to sell a house, you need to have the expectation it's going to take you 90 days to sell a house right now, like it has most of the time in the history of real estate. Most of the time in the history of real estate, that's how it's gone. And so you need to have a 90-day expectation on selling and negotiating on your price. That's normal. And if you're thinking about buying, you ought to go buy right now.
And like we said, a real estate reality check, you can always refi later when the rates come back down.
Yeah. If they come back down to 3, and they might, sure hope they do, that'd be wonderful, then refinance and get rid of that higher.
I don't know if I agree with all that, but interest rates are high. That I do agree with. How many of you can agree with that? I definitely agree with the fact that interest rates are high. They are definitely not where we want them to be. We're not at 3. But I believe things are changing. I believe things are changing drastically. And I believe it's getting ready to be a seller's market. Now, I want to talk to you a little bit about this because I think what we need to understand with the interest rates. Now, I'm going to tell you to buy. Yeah, buy and keep your credit good. Look, buy and keep your credit good because, listen, if you're not buying and keeping your credit good, then that's definitely going to be a problem for you. So we want to make sure you buy and keep your credit right. Just keep it right because you're going to need to keep it right. Remember, he said you could always refinance if it goes up. Okay, that's nice, but I got to keep my credit right. I mean, literally, that's very important, right? You got to keep your credit right. Credit got to be right, right? So that's huge. Huge, 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 huge. And I don't know if people understand that part or they don't get it. I don't quite know. I've been trying to work it out. But however, what I do know is that we got to most definitely keep things right. All right? Most definitely keep things right. So I just want to make sure that we're understanding what that means. Okay? What that means, and not just what it means, but understanding how much it means to us for the future and buying the house. We can't sit here, say, hey, I'm going to buy and I'm going to refinance, and we don't have our credit right. So I want to talk to you about a little bit about that as well. Getting your credit in order is not as hard as it used to be. It used to be really hard. Now they've got so many programs out there, but you got to be careful with these programs because they're becoming expensive because they know that everybody took a serious hit. What I mean by that is credit dropped around the pandemic time because folks weren't able to pay their bills, off jobs, things closed down, businesses were, down. A lot of things happened in that time frame, right? So because of that, everybody kind of took the credit went, was at 650 or 700, 650. Now it's down to 550. Maybe some even people are down to 3. I mean, it's down. So we got to look at the bigger picture. First thing we got to do to buy a house is your credit's got to be right. Look, and I'm going to give you some information on that. And that's one of the things that we do. We help you with your credit. And I want to make sure you know that I found a program, really good program, worked for me. And I know I had some serious issues that I was going through with mine. I was paying ahead of time. Okay, see, that's what I was doing. I was actually paying ahead of time, trying to get everything, y'all know me. I was trying to pay ahead of time so I could, hey, I was just trying to work it out. I thought if I pay ahead of time, we'd be good. I didn't know about credit the way I know about it now. Now I really know about credit. Now it's like, okay, I know how this thing works. I know how this is going to be. I'm very aware of it. And guess what? Yeah, I'm going to have to do something about it because I surely do not want, I don't want it to be like, basically, I'm not paying attention. I want to pay attention. So I had to dive in and find out for myself, what does that mean for me? What does that mean when you're talking about my credit? What does that mean? So, hey, I want to give you some information. I'm going to put some also in the chat for you guys. Those of you who are not don't have their credit in order and you want to get it, that's the first thing I want to touch on because that's huge. It's one of the biggest issues we're having now. People are not able to buy houses. They're saying, I got to get my credit right. But with these interest rates, again, too, a lot of banks are able to give you these, their loans for your mortgage. Because why? Because these interest rates are high. And guess what? People are struggling with trying to buy a house. They used to have it where you could buy a house with just your, what was that? They had it. You could buy a house with just your paycheck or your pay stub. They used to have it as that as well. So I've got some information in the chat. I'm also going to share here my screen with you that are here live with me because I want to share this screen with you so that you basically know, hey, this is the way we can get our credit. And then I'm going to put in there some information. I think it's important in all you're getting, you definitely get an understanding. And all you're getting, make sure you get an understanding, because that's really important. It really is. So this is our information on how you can go get your credit. You can go right up here, www.financy.com/credit repair. You can go right there. We restore. I want to say that we restore credit more than we repair credit. We want to restore. Restore means that it comes back to where it should have been in the beginning when you started getting credit, when it was at that 700, when it was at that, that 650, 680, that 800. That's what we want to do. We want to restore it back to those numbers. So we want to elevate your financial rise in premium loan approvals, generous credit limits, favorable interest. And you guys can click that too while you're in Clubhouse as well. I want you to be able to click that and get that information. I kind of agree with Dave Ramsey, then I don't. But I think that if we're going to refinance, we've got to have our credit in order. Things have got to be right. And we got to keep it in order. So it can't just be in order. It's got to be in order. Okay. And so I'm going to put some information for you guys to actually have as well, so that you can actually go in and actually click on that link, and you can go in and find out how you can sign up to get your credit in a place where it should be. Nobody wants to have their credit looking shabby. You're telling me to refinance, but I'm having a hard time just getting it together here. My credit is not even where it needs to be, because I took a big slump or a big smash in the year of the pandemic. So there you can go right there, go in and go to that website, and you can go in and you can get a part of that. That's one of the first things I'm going to tell everybody to do. That's one of the first things you need to do. That's very, very, very important. We can't get things together if we don't have our credit straight. I'm just being honest. They were going to pass some laws on this credit. I never seen them passed. I wish they would have done it. They should have helped us with that. They should have known. And like I said, there is a FAIR Act where in the pandemic, there was an act that came forth that you can actually write letters and ask them to excuse those late fees or take that off your credit if it was in the pandemic, in the time of the pandemic. If that happened in the time of the pandemic, if it didn't happen in the time of the pandemic, then it's not going to work for you. But there was an act where it was passed at the same time where they were having you to be able to write that letter. And so that act was passed as well in the pandemic, where you could actually, get a hold of those credit bureaus and say, hey, can you excuse this? Hey, can you knock off the late fees, for your credit? So I just want to make sure you understand there are some things that you can do, but there are some things that they're going to say, no, they're not doing it. So you can go to CFPB issuing credit reporting guidance. So basically it was a CARE Act that came forth, and the consumer reporting, where they stated that you have a right to go in and ask them to actually take that off your credit, or take the late fees off. But everything had to be happening around that time. It has to be leading up to the fact that it happened because of the pandemic. Some people are still using it. Some credit cards, some mortgage companies are still obliging by it and saying, yeah, we'll do that. So it was the CARES Act that actually passed that law, and it is in effect, where you can go in and you can ask for that excuse, or ask for that reporting to be removed, or that reporting to be changed due to the pandemic. So it's called negative reporting, credit reporting, but it was definitely a CARES Act that was passed, and you can use it. So I just want you to know that there are things you can do, or you can come to us and we can do it for you, where you don't have to go through that. You don't have to even experience that. So you don't have to do that. So and I want to kind of break down a little bit how the CARES Act, the Credit Act report scores does that. So recently they passed the Coronavirus Aid Relief Economic CARES Act, that the federal government puts in place special protection that changes the way some creditors report information to the credit bureaus. These changes can protect consumers who have been impacted by the COVID-19 and have made agreements with their creditors. So credit reporting scores under the CARES Act, and listen to this now, is response to unprecedented financial impact of the COVID-19 outbreak. So it has to be due to the COVID-19 outbreak. If your loan is considered current, not past due at the time you make agreement with your creditor to modify it. So you can call the creditors and they can modify it. And also you can tell them the change on your credit report. So listen to this. The Act protects the required creditors to follow our guidelines for the following agreement between January 31st, 2020 through July 25th, 2020, 120 days after March 27th of 2020, when the law was enacted. So 120 days from the COVID-19 national emergencies is declared over. So when was it declared over? 120 days after it was declared over is how you have to go back and look and see if it affected your credit then. Then it's 120 days after that you can claim up to with the CARES Act that affects your credit report scoring. Okay, I want to put that information. There is things you can do, but make sure you know how to write those letters. Make sure you know how to make that request known to your creditors. Also, when you're having conversations with them, that's the first thing I'm going to tell you to do, because that's like really important. No one says that, but it's important. Okay. Now let's dive into a few things about how we're going to fix, or should I say, how are we going to work with these mortgage interests that are happening now in this world? And, I want to be very blunt about this, but at the same time, I want to be truthful. I'm going to tell you a few things. A few things I'm going to tell you about is what the rise of the interest rates are, 2023 to 2024. And those rates are about to make some changes. When I was looking just looking some things over, I was thinking to myself, oh my God, we're 7.12%, 9.1%. It was pretty high. Now we're looking at a rate of likely to low sixes to fives, high fives to the low sixes. By the end of 2024 is what they're looking at on a 30 fixed mortgage. So let's kind of get into this just a little bit, because I want to make sure that everybody understands just kind of exactly what that looks like. I think that we definitely need to make sure we know what that looks like. Okay. So let's just go right up in here and let's talk about this for a minute. The rise of the interest rates. So this is the rise of the interest rates. And I want you to understand what that rise means. The rise of the interest rates, the mortgage interest rates, the rise of the mortgage interest rates. So we want to talk about the mortgage itself. What are the rises of the mortgage interest rates? Mortgage interest rates, because that's very, very, very important. I think the one thing too is when we're talking about the rise of them, if anyone remembers, we had this same conflict. If anybody remembers, in 2008 to 2009, this same thing came about. This is not nothing new for us. We've been through this already, right? We not seen this? Because I know we have. We've seen it. We have seen this. We've gone through this, got through it, and went well, walked out of it like a champ. So we're just going through this again. It's not nothing that we can't handle, right? So let's talk about that for 1 minute. And let's kind of dive deep into this just a little bit here. I'm going to share my screen with everybody. Sorry, I had it up. There was some things that needed to be taken care of there. There we go. All right, here we go. Rise of the interest rates, mortgage interest rates. So let's talk about that. All right. The rise of the interest rates for buying homes in 2023 varied. And they did. I have to say they were all over the place. I'm just going to be honest. I thought they were anyway. I thought they were all over the place. I'm just going to be really honest. I did. I thought they were really all over the place. But hey, who am I? I'm nobody. I'm just talking, My name's Marina and Summers, and I'm your host today. So I guess that matters just a little bit, right? And we're here with profit sharing and also financial language where money does have a sound. But I guess I'm nobody, but I'm trying to give you some information today. So listen, let's talk about these rise of the interest rates. Very dependent on several factors such as economic conditions, inflation rates, monetary policy decisions made by central banks. General interest rates for mortgages, home loans are influenced by the broader interest rates environment set by central banks like the Federal Reserve, United States, RUF, dazzling Mediterranean Romans, all those type of things were a part of what was going on with the interest rate. So being able to give you that information was some of the things that kind of made things change, right? One thing about this is in 2023, interest rates from home loan experienced some upward pressure, and they did. They had some upward pressure. Somebody say upward pressure. They were totally in pressure. So they had some upward pressure. And one of the things was central banks may have responded by gradually increasing their benchmarks, interest rates to the curb, inflation pressure. However, it's essential to note that interest rates can fluctuate throughout the year based on economic indicators and policy changes. Amazing, isn't it? Potential home buyers should keep an eye on market trends and consult with financial experts or mortgage lenders to understand the prevailing interest rates and to determine the best time to buy. Now is a good time to buy. You can refinance. It is a good time to buy. I won't say that it's not. It is. Because as soon as these interest rates drops, and they will, guess what? Everything's going up. The house cost is going up. It's going to be a seller's market. And I'll tell you what that means. The banks offer various types of mortgages. One is a fixed mortgage. Fixed mortgages is the interest rate remains constant throughout the entire term of the loan. That means that the borrower has the same monthly payment amount for the duration of the loan, providing stability and predictability. Adjusted rate mortgage is called an ARM. An adjustable rate mortgage features an interest rate that can change periodically based on market conditions. Not good, not good. In the initial interest rates, our ARMs are usually lower than those fixed rates mortgages, but they can adjust up and down after initial fixed rates period. So they can go up, they can go down. I'm sorry, I need some consistency. Another one is hybrid ARM. These mortgages combine features of both fixed rates and adjustable rate mortgages. For example, a 5/1 ARM has a fixed interest rate for the first 5 years, and adjustable annual thereafter. So it can go up after 5 years. Interest only mortgages. With an interest-only mortgage, borrowers will only pay the interest on the loan for a certain period, typically the first few years. After the interest-only period ends, borrowers must start paying both principal and interest, which can lead to a higher monthly payment. It's called balloon mortgage. Another one is balloon mortgage. A balloon mortgage offers lower monthly payments for the fixed period, after which entire remaining balance of the loan becomes due in a single large payment, known as a balloon payment. So you got your balloon payments as well. FHA, VA loans. Another one is where after which the entire remaining balance is due. FHA and VHA loans. These loans are backed by the Federal Housing Administration, FHA, or the Department of Veteran Affairs, VA. Often offer competitive interest rates and flexible qualifications. Require jumbo loan. Jumbo loans are mortgaged. These are called jumbo loans. Another one is jumbo loans. Jumbo loans are mortgages that exceed the conforming loan limits set by government-sponsored entities like Fannie Mae, Freddie Mac. Interest rates are jumbo loans may be higher than those on a conforming loan. Specific interest rates offered by banks for mortgages can vary based on the factors which, as the borrower or the creditor worthiness, loans amount, and loan term or current market conditions. Borrowers should shop around and compare their offers. So always shop around and compare your offers. Okay, always. Let's talk a little bit more. Let's talk about that ARM adjusted rate for a minute, because I see a lot of people that have gotten it and they're wondering their mortgage is going up and down. Another reason your mortgage can go up and down is because your insurance is shifting. How many of you know the insurance is going up? How many of you know that they're going out and they're even the city and this other state, rather your city or your county is actually going and doing assessments and raising what? Your taxes. That can cause your loan to come up, your mortgage loan to come up as well, because they're raising your taxes on your mortgage, and they're also raising your insurance. Boy, I saw that on there. I thought I had to call them. I said, "Hey, what's this? $50. Oh yes, your insurance." I hurried up and bought more. I said, "Oh, we got to get away from this insurance company. I can't stay with y'all. I'm sorry. I got to move around. I'm not getting ready to pay an extra $100 and something a month on my mortgage." You mean to tell me you jumped from $4,200 to $50? What was it? No, I'm sorry, $4,100 to $5,300 or something a year? I'm gonna need to cut y'all loose. Because I know I can't do it. I'm just saying. Y'all hear what I'm saying? I'm just saying. Okay. So these are adjustable rates. That's another reason your mortgage can go up. Okay. So the initial interest rate on an ARM is usually lower than the prevailing fixed rate. Mortgage rates making it attractive option for borrowers look for lower initial monthly payments. However, after the initial fixed rate period, often refers to as the introductory period, the interest rate adjusts periodically based on the changes in the specific index. Remember, there was that 5-1. You can also do a 5-2, 5. It just depends. First 5 years, and then your interest rate's going up. Remember, we talked about what that means, right? I mean, let's just talk about that again. 5-1. An ARM has a fixed rate for the first 5 years and then adjusts annually. So every year, every 12 months, it gets adjusted. That every 12 months means it can go up or it can go down. I don't think I want a rate like that. That's just me. Then it says, now if you do get that rate, keep your credit right and know this, you can refinance and you can get a fixed rate. Okay? You really can. So the adjustment period for the frequency of the rate changes vary depending on the term of the loan agreement. Common adjustment periods include every 6 months, 1 year, 3 years, or 5 years. So you'll see that in your contract when these adjustments will start taking place. That's why it's important to read the paperwork. A fixed percentage to the current and index rate. ARM loans often have caps that limit how much the interest rate can adjust. Make sure you look at that if you end up getting an ARM adjusted rate. Got to read. So, for instance, periodic caps over the life of the loan, lifetime cap. These caps provide some protection. And I want to talk to you about that as far as the protection goes. Because that's pretty interesting when I thought about that for 1 minute. That's pretty interesting. So, when you're talking about the ARM rates, you're talking about there's a fix. What is that fix? Well, it's not the rate. The fix is when the ARM begins and when it stops. I say never when the stop part. But it says here, as I'm looking this over, and I was doing some research on this, a periodic cap over the life of the loan are lifetime caps. These caps provide some protection to borrowers against dramatic increases in their monthly mortgage payments. Borrowers consider ARMs should carefully review the terms of the loan agreement, including the initial fixed rate period, adjustment period, index used for the rate adjustment margin and caps. Understanding how the interest rate can change over time is essential for making informed decisions about the affordability and the risks associated with the ARM loan. There is a risk associated with the ARM loan. Okay. Next thing is, let's talk about those 2022 to 2023 interest rates. So after witnessing nearly, and this is anybody know Greg McBride? He's the Bankrate chief financial analyst, and he predicts the turbulence. Predicts all the, and I got this information from what he had actually said and his basis in this and his voice in it. And I kind of take his stuff pretty serious. So let's talk about this for 1 minute. After witnessing nearly a double increase in home finance costs in 2022, and I've kind of put this in my own words of when I was reading this, and I was reading under Greg McBride and seeing what he had said. There's some reprieve on the horizon of the potential home buyers in 2023. Bank rates and financial service website forecast that interest rates and a 30 fixed rate mortgage in the U.S. is posed to decrease to 5.25% by the end of the year. This anticipates a drop of 1.49% points from the current rate and nearly 2% points from 2022 peak rate, which was at 7.12%, offering a glimmering of hope for prospective buyers. This projection is attributed to the expectation of decelerating the economy in 2023. The reserve persists on rising the benchmark interest rates to combat elevate inflation levels. Despite strides made in the federal curbing inflation, reducing it from year-and-year peak to 9.1% in June to 7.1% by December. It remains far from the target of 2%, consequently. So they're not saying we're going to see that 4% or that 3% at this time. Just putting that out there. You might see that 5%, but you're not going to see that 4%. While rates hike, it can help mitigate the inflation by, heightening the cost of borrowing money. They also dampen investment potential, triggering economy contractions. Job losses, historical mortgage interest rates tend to decline during a recession as they're closely tied to the borrower's economic landscape. So we've got to look at the fact that a lot of things are curbing into this. There's a lot of things that are dictating what it's going to be like for those interest rates at right now in this particular time and moment. And that's got a lot to do with the inflation. It's got a lot to do with the job market. It's got a lot to do with the economy and what's happening. Now, you remember, it's like economy. The pay rate went up, and then all of a sudden, it either dropped or it plateaued. So that has a lot to do with these interest rates as well. Now, Greg McBride says, and he is the chief financial analyst, predicts the turbulent trajectory for the mortgage rate in the first half of the year, followed by more subsequent declining. So he's going to see subsequently, we're going to see some declining in latter part of the 2023, which we had. This anticipated a notable pullback in mortgage rates coincides with the decrease in the inflation. So this kind of coincides with after decrease in deflation. So as the inflation decreases, you're going to see the interest rates decrease. But the mortgage, the rate on the home, when I'm talking about the cost of the home, is going to go up. Interest rates go down, home inflates. I just have to say that. The cost of the home is going to go up. So where your house was now $350,000, it might be worth $400,000. Or it could be worth $375,000. Reduction in mortgage rates would offer a welcome respite to potential home buyers, lowering their monthly home ownership expenses. However, it's worth nothing that a projected decrease won't reach pre-pandemic lows. Furthermore, persistent housing shortages are expected to keep prices elevated. So guess what? It's keeping the houses also expensive. House shortages. People trying to hang on to their houses, okay? Leading many would be homeowners to remain on the sidelines in 2023. Now this is Greg McBride. Leading many would be homeowners to remain on the sideline in 2023. So don't sell. That's basically what he's saying. Just hold off a minute here. Because once those interest rates go down, guess what's going to happen? Y'all know what's going to happen? Homes are going to go up. The cost of houses are going to go up. And we have a shortage already. So let's talk about the drop in 2024. Mortgage rates are anticipated to decrease later this year as the U.S. economy weakens, inflation slows down. The Federal Reserve implements interest rate cuts. Projections suggested that 30-year fixed mortgage rate will likely fall as low as 6% range by the end of 2024, further dipping into the high 5% territory by early 2025. I'd have to say that there are some even lower than that. There are some you can get even lower than that. I have to say that. So here's a breakdown of where the mortgage rates are. So I want to talk about that breakdown for 1 minute here, because I think that's important that we talk about what is the breakdown of the mortgage rates, because there is a breakdown. Trust me, there's a breakdown. There is a breakdown. And we got to make sure we understand what that means. Because when you're thinking about this and you're looking at the mortgage rates, so the mortgage interest rates didn't quite follow the predicted path. I want you to hear me. So actually, they trended higher, reaching a peak of 7.9% in the late October. However, they have since pulled back, currently hovering at 6.6% by the end of the year. As we look ahead in 2024, economists anticipate that Fannie Mae, and I want you to hear me, because this is what they're predicting is going to happen. I'm going to tell you what I think, but I'm just going to, give you something here. I believe we're going to take a dip. Yeah, I believe we're going to take a dip. but I don't believe we're going to take a dive. But I do believe that we will take a dip. Oh, yeah. Oh, yeah. I believe that with everything in me. I do. I believe that we will take a dip. But a dive? No, not yet. It's coming, but it hasn't come just yet. But I do believe we are going to take a dip. That dip's going to come, and when it does, oh boy, it's going to be good. So I want to talk about what that looks like when you're talking about these dips and dives, okay? Because that's one of the things that I think that, you know, we need to anticipate, that we're going to take a dip, but we might not take a dive. I'm just saying. Can everybody understand me on that part? Can you just agree with me on that? I mean, I know that's a big word, but a dip's good. A dip is good. A dip is not bad. A dip is good. It's a dip. It is a dip. I mean, we got to look at the bright side, but it's not a dive. I'm just saying. And I know everybody was looking at taking a dive. That doesn't mean that it won't be time to buy. Of course you can buy. And you could even sell as long as the interest rates are going down. I wouldn't do that right now, only because, you know, it's going to be a buyer's market. And I'm going to tell you about what a buyer's market is, because I think it's important that we understand what is a buyer's market. And that's a serious, to me, that's a serious statement. What is a buyer's market? Because that really does matter. And I think the one thing that we have to understand is, what is that? And what does that mean for me? Okay. What does that mean for me? What is a buyer's market? And I think that that's a good question. What is it? And I want to talk to you about that a little bit later here, but I want to make sure you understand that you might be the buyer's market. By you holding onto your house, you could be the buyer's market. So, because inventory is short. They just said inventory is short. So because inventory is short, guess what? They're saying, hold on to your houses. Hold on. Don't sell yet. Hold out just a little bit. Just a tinky. Just a little bit. I'm not asking you to do it forever. I'm just asking you to do it. Okay? Just a little bit. Because it's getting ready to be in your best interest. It's getting ready to be where you can make a bundle and maybe go buy a jumbo loan where you can buy several properties instead of just one property. You never know, right? So I want to be able to share some things with you as well here. So let's get right into this, because I want to talk to you a little bit more about what this looks like. And I want to make sure that everybody has an understanding. So let's talk about these interest rates on 2024. And then we're going to talk about more about what that buyer's market looks like. Okay. So as you're looking at the 2024 the drop, so they're saying that this is going to drop, that we're getting ready to see it. Mortgage rates are predicted and forecasts, and various sources indicate that there's a downward trend, and there is a downward trend coming. The census suggests that the gradual decline, why rates are expected to decline, anticipate that interest rate cuts by the Federal Reserve in the second half of 2024. Well, we're coming up on that second half. Everybody knows that, right? Coupled with the weakening economy, a slow inflation are driving expectations for a lower mortgage rate. How rates impact the housing market? Lower mortgage rates can stimulate home buying activity. So that means lower mortgage rates means that people are going to want to buy homes. But guess what? We got to have the inventory. Mortgage refinancing rate forecast. Refinancing rates are also expected to trend downward, offering a homeowner an opportunity to lower their monthly mortgage payments or shorten their loan terms. Ooh, that might be good. That might be real good. Overall, while the forecast provides valuable guidance, and it does, valuable guidance with this, it also says uncertainties remain, and it's essential by home buyers, sellers to stay informed and consult with financial professionals. Always consult. Always, and all you're getting, get understand. Let's talk about this 2024 drop. And it's a drop. It's gonna decline, but it's not gonna plunder. Okay, so there's gonna be a drop there. Fannie Mae projects that the average 30-year fixed rate will approximately be at 6.4% in the first quarter of 2024, gradually decreasing to 5.8% by the end of the year. This marks a notable downward adjustment from the previous forecast. According to the Mortgage Banker Association, MBA, they expect 30-year rates to commence at 7.1% in 2024 with a gradual decline to 6.1% by the end of the year. They anticipate a potential drop as low as 5.5 in 2020. That was their prediction, but that's not the way it's going. Okay. The National Association of Home Builders forecast an average of 7.04% for the 30-year fix in 2024, followed by the decline of 5.81 in 2025. Now, nope. That 5.8 is coming in 2024, not in 2025. I believe it's even going to drop even more in 2025. Do I believe we're going to get back to the 4% %? I do, gradually. It's important to note that these predictions are subject to uncertain and actual and may differ. So you can't take me here. These are predictions. These are big-time predictions. Financial experts is crucial, as wisely stated by the Federal Chair, Jerome Powell. Forecasts are highly uncertain. Forecasts is very difficult, and forecasts are a humble lot with much to be humbled about. So you've got to think about it. They can change and shift. We just talked about how they can shift. Okay. Now let's talk about this buyer's market. When this happens, these interest rates start going down. Houses are going to go up. They're going to inflate. So where your house was 300 might be worth 325, maybe 350 now. A buyer's market refers to a situation in a real estate market where conditions favor the buyers rather than the seller. In the buyer's market, there tends to be an abundance of housing inventory available for sale, coupled with relatively low demands from buyers. As a result, buyers have more options to choose from. So you might see more people selling their houses now than you did in 2023 because their houses are going to go up. So they might have just been waiting on it and sitting on it for this day to come. You might see a lot of people also getting HELOCs as well. And I'll talk about HELOCs next week. I do want to talk about those and how important they are. There is the bird effect. I got taught that bird effect by a friend of mine, and it definitely works. Longer time on market homes tend to stay on the market for an extended period without receiving offers or selling. Sellers may need to adjust their pricing and marketing strategies to attract buyers. So let this high inventory, there are more homes listed. So people are going to sell, which means there's going to be higher inventory. Which means your house, what did Dave Ramsey said? Your house is going to be on the market longer. Now, you know, and I know in the pandemic, everybody was taking them houses off the shelf. Like you couldn't even turn around quick enough. They were gone. But now things have slowed down, but they're getting ready to pick back up because more people are going to sell their houses now because their cost is going to go up. Price reduction. Sellers may be more willing to lower their asking price or offer incentives to attract buyers in the competitive market. Favorable terms for the buyers. Buyers may have the upper hand in negotiating, allowing them to request concessions such as closing cost assistance or repairs from sellers. Look at that. Did y'all hear that? Terms for buyers, and buyers have the upper hand to negotiate, allowing them to request concessions such as a closing cost assistance or repairs from the seller. From the seller, not the buyer, the seller. Overall, buyer's market presents favorable conditions for those looking to purchase a home, as they have more options and bargaining power. However, it's essential to note that market conditions can vary by location and can change over time due to the factors such as economic conditions, interest rates, and housing supply and demand dynamics. I just want you to understand. This is 2023 versus 2024. Thank you, everyone, for coming in today. I am Marina Summers. I am your host with Financial Language. Money does have a sound. But I just wanted to give you some updated information that I truly believe is going to help in the long run. I'm just saying. And I think it's important that everything, again, get that credit right. Because even if you buy now, you can refinance in a lower interest rate. That is coming our way. We are announcing it's coming our way. And so we want to make sure that, hey, you guys don't miss out on that. I don't miss out on that. Nobody misses out on that because it's very important. Very important that we get it. I'm telling you the truth. It is. It matters. It does matter. And nobody wants to miss out on that. Nobody does. I know I don't. But I'm looking forward to. We didn't sell. We didn't sell nothing. We didn't do anything. We were like, no, we're not selling. You know why? Because I knew this day was coming. I knew this day was coming. I knew it was coming. I was just waiting on it. I was waiting on this day to pop up and say hello. And it did. It popped up and it said hello. And there it is. So you got to look at the bigger picture. There's a bigger picture. And sometimes we think it's this, but it's really that. It's not this, but it's that. Houses are getting ready to get back on the market again. Sellers are going to be asking for more from you as a seller's market. So as a buyer's market, so you got to think about it. So this is going to be your market, your time. So they're going to be asking more from the buyers than they are from the sellers. Okay? Let's think about it. And that buyer's market is, I truly believe it's going to be the buyer's market. I know people will say it's the seller's market. I know the houses are going to go up, but I truly believe that the buyer's market is going to be the number one thing that's going to happen. But why? Because there's going to be more inventory. There's going to be more houses to buy. You're going to have to come up with some negotiations, but they're going to be ready to sell. I don't believe it's going to be a seller's market. I believe it's going to be a buyer's market. I do. I believe the ball is going to be in your court, and I'm excited for you because I'm going to be one of them buyers, right? I am. I'm going to be going out here and I'm going to be buying some stuff, fixing it up, and I'm going to be flipping it like, a flapjack, pancakes, because, hey, I believe in the wealth of the kingdom. So I want to thank you for joining me today. I appreciate you all for coming in. And listen, this is Financial Language. Don't go nowhere, Clubhouse. I'm going to be with you in a second here. Financial Language, thank you for joining us, and we'll see you soon. This is Marina, your host.
Marina.